In August of 2011, the United States government's credit rating was downgraded by one of the world's most influential credit rating agencies. Other credit rating agencies didn't agree. According to most credit raters, the U.S. government still has some of the best credit in the world. But that's no longer a unanimous view among people in the finance industry. You might remember that the downgrade in the U.S. government's credit rating followed a long, drawn-out controversy between Congress and the President concerning what kind of fiscal policy should we have? How much should the government spend? Should it tax more? And above all, shouldn't we be avoiding the increase in national debt? More debt means a loss of credit rating. The debt of the government of Greece is far too high, and that country has lost its credit rating. And when individuals, businesses, and governments lose their credit rating, they have to pay more to borrow. They have to pay higher interest rates, which means the taxpayers are going to pay more. When the U.S. government's credit rating was downgraded by one important agency, I was very critical of our elected officials. I still am. I expected the logical consequence, which is that we taxpayers and the government acting on our behalf was going to have to pay higher interest rates to borrow, and that at least in the foreseeable future, the government was going to continue to run a deficit in fiscal policy for at least several years before the budget could be balanced, which meant that we were all going to pay more down the road for the situation we're in now, and for a situation that was aggravated by political action, or I should really say by political inaction. Well, it turns out that it's a little more complicated than that. Since the government's credit rating was downgraded by one agency, the marketplace for money, the marketplace for investment has sent a completely different signal. The main way in which the U.S. government borrows, or the largest source of its funding, is the issuance of what are known as treasury bills or treasury notes. So to get a shorthand view of how much interest the government is going to have to pay for its borrowing, which we, the taxpayers, are going to have to pay down the road, is to look at the interest rate the government pays on its 10-year treasury note. That interest rate is influenced by the policy actions of the Federal Reserve. So one arm of the government, one government agency, the central bank, can help the government to pay low interest rates. But as I've explained before, the Federal Reserve doesn't really control, it only influences interest rates. The final decision is made in the marketplace. Are people willing to buy U.S. government treasury bills? In other words, are investors willing to invest in the credit of the United States government? Well, it turns out they are. Contrary to what we would expect, more investment has flowed into treasury notes since the downgrading of the U.S. credit rating. In other words, investors did not agree with the credit agency. They have continued to extend more, and in fact, even more credit to the U.S. government. The U.S. government is now able to sell its notes at such a good price that it is paying only 2% interest on the national debt. I'm pretty sure that most people who have mortgages, most businesses that need to borrow to finance their new operations or new products would love to finance at this rate. Certainly people who take out student loans would love to get that interest rate, or have a credit card would love to get that interest rate. That interest rate is below the rate of inflation. So here's a little piece of good news. The world still thinks the U.S. government is one of the safest investments in the world. Safer than the stock market, safer than other countries in many cases, as safe as gold, maybe even safer than gold, which will probably eventually fall in price. Whereas, so long as the US government is solvent, these notes get paid off in 10 years with interest, although at a very low rate of interest right now. The good news here is at least now, at least in the time before us, the government does have the ability to continue to use fiscal policy, either by keeping taxes low or perhaps by funding education or infrastructure, new airports, new roads, up-to-date systems of transportation and communication. Those methods of fiscal policy, which can hopefully help us to bring down unemployment, are things we can still finance as of this time. I hope this presentation has helped you to better understand the facts and political dynamics of government economic policy. If you have any questions or comments, please feel free to post them to the website.